Welcome everybody to another instalment of the Red into Black webinar series. I'm Stephen Michelle from PCI Partners, and today it's going to be a very interesting topic that we've got for you, which is an economic and budget update. And given the budget was only handed down a couple of days ago, I think it's very, very timely, and we appreciate very much Judo Bank attending this to actually give us their thoughts in relation to what's actually happened. So I'm going to hand over to Con Volusius, who's the National Partnership Director at Judo Bank, to introduce our guest speaker and tell us a little bit about judo. As always, there's a chat function at the end, at the bottom of your screen. Please feel free to use that during the session, but we'll take questions at the end. So over to you, Con.
Thanks, Stephen, and thanks everyone for joining. Looking forward to a really good session from Warren. Just so everyone's aware, Judo Bank is a relatively new player in the market. We're a specialist SME bank in Australia and listed recently in November of 2021. We're the fastest growing bank in Australia, and we're really keen to help SME businesses grow in the current environment. Our speaker today is who's the Chief Economic Advisor to Judo Bank, and also he's the Managing Director and Founder of BQ Economics, and previously has a long career as Chief Economist for ANZ, worked for Westpac, Credit Suisse, New South Wales Treasury, and also the Australian Government as well. We're very privileged to have Warren advising Judo Bank, and Warren has put together a great summary of the budget from the other night. So looking forward to everyone being involved and posting some questions at the end. We'll have 10 or 15 minutes, hopefully, at the end for you all to ask Warren any questions, and not just budget related. If there's anything else economics related, feel free to ask him. Sorry to throw that in there, Warren, but I'm sure you'll be okay to answer those. But thank you to PCI for organising this, and looking forward to hearing from you, Warren. Over to you.
Great. Well, thanks, Con. Thanks, Stephen and PCI for putting this on today. It's a good opportunity to take a step back, and we've had solid 36 hours to digest the budget and think about what it all means in the context of our economy, because there are important measures in there, and I'm not going to go over the detail of the budget. That's for someone else to do, and we don't have time for it either. What I want to do is talk about that budget in the context of the economy, and the economy is all important now for everyone in Australia because it's operating at quite an extreme setting. To not put any to soften it, we're running out of capacity. We're getting inflation. We've got labour shortages, and I'll go through all of these issues as a starting point, and particularly in relation to how these affect businesses, and then talk about what this budget means in that context. So I'm going to share my screen, show lots of pictures as normal, and then at the end take some questions. So let's get started. Let's hope I can do this reasonably smoothly. There we go. I assume I'm up and running. All right, so on behalf of Judo Bank, that is very much, as Con said, new to the market and here to support growing businesses. We're growing. I'm on the Sunshine Coast right now next to the judo surfboard, and this is actually what's happening in this economy. We are growing and we are moving forward. So look, before I get into it, I just want everyone to contextualize the situation we face right now with some bigger picture issues around what the pandemic has done. You could argue what this war in Ukraine is doing to the economic operating environment. The modern economic model that Australia has set up in the last 40 or 50 years that has brought us so much prosperity is based on a number of things that I believe right now are under pressure. One is the closed border. We're an immigrant nation. There's no two ways about it. Whatever your politics, you can park that for the time being. The reality is our economic structures are based on bringing people into this country every year as part of that labour force. The borders were closed, and it's been a major shock to this economy. Two, fiscal responsibility. Yes, our governments help the economy when it needs it, when there's a recession or a threat of recession. But once the emergency's passed, once the economic stress is gone, the governments work hard to get the budget back into balance. And that's a big focus of today. Low and stable inflation. For 30 years, we've achieved that. It's really important. And we're now seeing that environment be very, very stressed globally. And here, it's happening here. That's all the cost of living stuff. That's an important issue. And finally, globalization. Australia is highly connected to the world. A lot of our prosperity has come from that connection, not just about selling minerals and agricultural product to the rest of the world. We actively got a strong active capital market. We import a lot. We are a highly connected economy into the world economy, and globalization is under question. It's paused for at least 10 years and now looks like it could be going backwards. Now, in the long sweep of history, we always get back on that globalization path, but there are times when it can go backwards for a period of time, and that can be a threat to Australia. So bearing in mind these sort of issues that sit there as a challenge to us, some which we can control more than others, I now just want to go into what the current economic environment is and what the budget means within that context. Firstly, just quickly, I'm not going to dwell on this. I'm sure the slides will be made available later. The world economy is doing well. All the stimulus provided through the pandemic, we are now really growing strongly all around the world, and strongest rates of growth in the world. This over on the left is European unemployment. It's the lowest in decades. US is almost back to its pre-pandemic lows. We're well through them. That is as good an indicator as any of how well these economies are doing. Part of that, though, is this inflation. That's the US inflation going back sort of 60 odd years. You can just see how stunning the recent rise is. I'm sure everyone's seen this picture now. It's nothing new, but this inflation is new. We're not used to it. And it's very much about the pandemic, and it's very much about the challenges we face all around the world, as well as here in Australia. Finally, just to be clear, for those worried that the surge in oil prices is going to knock the economy, the global economy, into recession, I really doubt that. We've seen it before. In fact, in real terms, adjusting for the cost of living, for inflation, oil prices have been high. They're wildly volatile in the last few weeks. They were high before Russia invaded Ukraine. It's not just because of that war that this is happening and the sanctions on Russia. But I just want to make sure that we're clear that this is not the sort of thing that's going to tumble us into recession. Why? We've seen it before, but most importantly on the right, the energy intensity of economic activity is on the decline. And what that means is that we're getting more and more efficient at using fossil fuels as our energy source. This data here, 30 odd years, everyone's getting more energy efficient. The original impetus for this was the oil price spikes of the 70s, the rise of the Honda Civic, I call it. But it was everything. It was ubiquitous. And of course, now we've got the energy transition. So the data is only up to 2020. When the 21, 22 data, 23, 24, it's going to go even lower as we move away from fossil fuels. So the chances of the oil price and disrupted oil markets creating a global recession is very low, in my opinion. There's a lot of momentum all around the world from very stimulatory policy settings, fiscal policy, and that momentum's carrying right through to this year. Equity markets are within 10% of their highs. Say no more. If we really thought we were going to have a global recession, that would not be happening, in my view. Oil prices, inflation, bond yields, uncertainty around Russia, the severity of that situation potentially, but equity markets are strong. Now, there's a lot of reasons for that, but it just shows you that this talk about recession, I think, is overblown at this stage. It doesn't mean it won't happen at some stage, but just not right now. That's not the main challenge. Yeah, it's quite the opposite. But we need to watch Germany. This is their business survey, very popular one, good one, been around for a long time. The reading from earlier this week for March shows that if there's going to be an impact from the war in Ukraine, it's going to start in Germany. It's going to start in Europe. This is confidence. It's not actual. And actually, I'm spoken to a couple of businesses with operations in Germany, and they're sort of soldiering on pretty well. They're sort of looking through this. They're going to manage it. But anyway, I just wanted to paint that international picture. Now I'm going to paint the domestic picture. Our economy has come roaring back to life, and we shouldn't be surprised. Over on the right is a chart of GDP each quarter. And you can see the big initial lockdowns in 2020 had a big impact. Then we jumped right back with all that stimulus, all that support from the government, from monetary policy. In this country, every level of government was doing something. It was unprecedented. We suspended the insolvency processes. Everything was thrown at this. The most concerted and significant effort by governments to support the economy we've ever seen, and it worked. We should have got a feel for that, but then we had the Delta lockdowns that knocked us back a lot less. And of course, in Q4 last year, the bounce was incredible. Now, the dotted line is this concept of potential. And I just want to highlight this point that the economy is doing so well that we're running up against our capacity. It's in this economy, it's best evidenced by the low unemployment rate, where we've got chronic labor shortages, which I'll go into. But I think the two key issues that I hear from business, and I think are widely accepted now, and are two of the most important dynamics facing the Australian economy over the next few years is retaining and attracting staff. These labor shortages, they're ubiquitous, they're everywhere. Doesn't matter what skill level, what industry, what geography, it's happening everywhere. In some businesses, in some industries, it's crisis point in terms of operational effectiveness. In many small and medium businesses, people have been worked hard because you can't get the staff in there. They're keeping the thing churning, but this is not sustainable. It's a really, really important point and important issue for not just our economy, but for our society. The other one is this inflation. We're seeing it in this country. It might not be CPI just yet, although I suspect when we get the next quarterly number, it will start to really come through. But every business is seeing it in terms of costs. And this is a key theme for me. Businesses have got a new competitive dynamic, and that's how they manage these costs, how they can mitigate them, how much do they take in terms of their profitability, and whether they can pass it on to their customers. Because in the end, ultimately, it's all about getting back to some steady state where you pass that on to your customers. And that's actually really the big competitive pressure in the business community. And I think insolvencies will start to rise. And I don't think there's going to be more businesses going under, unfortunately, in the next 12 months than we've seen for many years. And this is going to be that process, I believe. So getting that inflation and those costs under control is critical from a policy as well as an individual business perspective. Why is the economy so strong? Because we literally threw the kitchen sink at it. Interest rates at zero, massive fiscal stimulus, and it's all still in place. The world has changed a lot in the last 6 months, and particularly our view and our thoughts on the economy. And unfortunately, Australian policymakers have been slow to react to this shift. And the Reserve Bank was describing us as being in a low inflation environment not 6 weeks ago, which is ridiculous in my view. But the policy stimulus is there. And there's one thing that's happening that not a lot of people are talking about is the Australian dollar is not doing what it would normally do. Okay, normally the Australian dollar has a very strong relationship with our export prices, that is commodity prices. I've got a chart here going back 12 years. You can go back 50 years if you want. The fact is that any model of where the Australian dollar should be is based on commodity prices and interest rate differentials, and it should be higher. This is why petrol is over $2 a litre in this country, even though oil prices are not at record high levels, because the currency is not doing what it normally does. It's not providing that buffer, which has been so effective for Australia in the last 30 years, having a floating currency. And this is obviously creating issues for the economy. People aren't talking about it, but that is highly inflationary. As an aside, just as one way to think about it, if you go back to 2010, 2011, 12, at the last commodity boom, how did the benefit of those high commodity prices get passed on to everyday Australians? It got passed on through a strong currency, which meant every dollar an Australian person earned had more spending power in the world economy, whether you're going on holiday, whether you're buying a car, whether you're buying a fridge. That's not happening this time. And that's a problem in this environment. That Aussie dollar is at 75 cents. It should be closer to parity. And of course, that's creating an inflation pressure in the economy. The fiscal stimulus is sitting there. Having been a bank economist, I was learned very early in the piece that once the money's in the system, it's in the system. It's just what happens to it in the system. We have savings in Australian households like we've never seen before in terms of how much saving there's been versus what people really needed to do. I've been working on these savings intentions measures. This comes from the Melbourne Institute's quarterly consumer sentiment survey. You can see it's a pretty good idea about people's intended in savings or what they want to do. And you can just see how much more we've done. It's about 200 billion basically, and you can see it, it's in the bank numbers, the APRA numbers. Prior to the pandemic, Australians put about $10 billion of new money a month into bank accounts, in terms of transaction accounts, savings account, term deposits, all that sort of stuff. Since the pandemic began, it's 20 billion. So there's a lot of extra money in the system. You can see big corporate companies that are got a lot of transparency and pressure on them to run their balance sheets efficiently have been returning money to investors like crazy in the last 12 months, dividends, share buybacks, this sort of stuff. It all ends up in these bank accounts. So this high level of savings is great. It's a buffer. It's going to give a tailwind to the economy. It's not evenly distributed, as you can imagine. So we still have many people who haven't got extra savings. And it's a big unknown about what happens with this. I think a lot of it's going to go into the property market personally, but a lot of it's actually going to go in overseas holidays over the next few years, I'm sure. But that's 200 billion. That's a lot of overseas holidays. You get my point. That's the fiscal stimulus of the last 2 years still in the system. And then household wealth is an insane proposition, what's happened here. So to cut to the chase, net worth, that is total assets minus liabilities. The assets are super, housing, that cash we just talked about. Liabilities are basically mortgages. You net it out, net worth has gone up by $2.7 trillion in 5 years prior to the pandemic. In 1 year of the pandemic, it went up by 2.2 trillion, which is a ridiculous proposition. That is not reality. So this is whatever we want to think about in terms of what that means for our community, our society, the distribution of wealth, and all of those things. We can park that from an economic point of view. That's a lot of money, a lot of their bloated balance sheets. It's a lot of borrowing power. And this is not going to be a weak economy when we've got these kinds of balance sheets sitting there for the household sector. Issue number one, labour markets and labour shortages. On the left is job vacancies. We get this every 3 months from the ABS. This goes back to 1979. Unfortunately, I'm not quick enough to update the data. The latest data came out at 11:30 today, if you can believe that. It went up another 4%, I believe, to about 423,000, up again. But just be clear, this is a reliable indicator. It moves around with the economy, up and down. I've run models on this for years for where labour demand's going. What's happened in this pandemic is literally through the roof. Never seen anything like it. Okay, if that's not just warning signs, I mean, you don't want economies doing these radical things. This has real implications. This is business stresses and strains and people making decisions about changing jobs and a whole range of things. It's a good problem to have in many ways, but we've overcooked it. There's too much. You don't need to go that high to promote a solid, strong economy. They didn't know that. They just erred on the side of doing too much, not too little. Well, I think it's pretty clear they did too much. But there's a massive demand for labour in our community. And on the other side, the working age population's collapsed because we are an economy that is used to having half of its labour supply in the last 15 years anyway, each year come from overseas in the form of temporary and permanent visas. And of course, that stopped at the flick of a switch. And of course, with temporary visa holders leaving the country, our population's actually been negative for the first time in 100 years. And I'm sure you're all aware of that. But just sit back and look at that. It's not just that we've got a normally, what would be normally regarded as a strong labour market. It's not just like that our supply of labour has softened a little bit. It's that one's gone through the roof and one's gone through the floor. And in economics, if it gives you anything scientific, it's when supply and demand shift, prices shift. So it's quite a severe situation. Probably one of the most profound things in the budget, which the government tried to not make a big announcement about, was the fact that they are rebooting the immigration programs. They actually announced the first numbers back in November last year for 21-22, 160,000 permanent visas for this year, about half of them skilled, half of them family. And a plan, which they've had out there for a year now, to get net overseas migration numbers back to where they were prior to the pandemic within a couple of years of 235. Okay, so a few comments on this. First of all, the current data, these are arrivals numbers from the ABS. This is the only information we have on what's actually happening at the border. And after a couple of years of very little happening, unfortunately, we still had New Zealanders coming in and out. I'm just kidding. I shouldn't say that. My parents are both New Zealanders. But you get the idea here that there was a few things happening. But since they actually rebooted the immigration programs in November last year, it started to shift again. So the data for December was 11,000 permanent arrivals. January was 8,000 permanent arrivals. In the year of 2019, before the pandemic, the monthly average was about 8,000. So we are quickly, people want to come here. People have been waiting, what have you. They're coming back in. It's early days. but we're going to see a pickup in that component of labour supply. I'm confident of that. But given the severity of the imbalance, this is not a silver bullet. This isn't going to change the story. It'll help ease the pressures in the labour market, but it doesn't fundamentally change it. And let's just look at the history of net overseas migration. Wonderful 160-year history. I've got to find out some Australian historical event back in 1861. In America, they talk about since the Civil War. But anyway, what you can see here is not just how historically unusual the pandemic's been for immigration. We only have one other similar episode, which was World War I, which was pretty big. World War II had a similar effect, not as sharp and severe. But I'll just make the point that in both those two episodes, there was a period of catch-up. There's no period of catch-up planned by the government. In fact, they tried to sneak through these numbers in the budget without any fanfare. You're already starting to see parts of the media bring it to everyone's attention and start to stoke that very politically difficult issue, which is insane in Australia that immigration is politically difficult when basically the country is built on immigration and we're very good at it. But anyway, I'll park that for the time being. We can, as a country, have a discussion about immigration and we can decide to get rid of it. Fine. It's not for any one person to decide. But the reality is our economy's structures are built around it. And if we're going to change our approach to it, we should be prepared for the consequences. Some of them could be considered to be good. Some of them not so good, what have you. Point I'm getting at is that we're not planning to play catch up this time because it is a politically difficult issue. And that means we've got 600,000-700,000 less people in the country than we would have otherwise had. And of course, all of our planning and everything's based on things just sort of going along. I think it's material. As I said, the immigration story will help, but it's not going to fundamentally fix the imbalance in the labour market in Australia. So tight labour markets have many implications. You've already seen a big increase in industrial disputes, strikes in the December quarter. That'll go even higher in the March quarter. And this is despite union membership being at a record low, but they will be important benchmark outcomes that will signal to the rest of the labour force. We can talk about that all we want. I think it's a fact of life now. We'll see. The one I think is going to be most disruptive and difficult is the fact that workforce turnover, you can see here on the right, is defined as people who left their job or changed their job in the last year. And that has been in decline for almost 40 years. Okay, now this data only goes to February 21. Everything I've seen, and I'll show you some data in a minute, shows you that's turning around big time. So we're not only seeing a big lift in staff turnover across the economy, and the tight labour market is obviously the reason it can happen, both in terms of motivation and opportunity. Higher cost of living, that is inflation, is giving especially low-income workers a real reason to do it. But we're just not used to operating in that environment. I mean, a lot of people have been asking me for a year now, how do we deal with an inflationary environment? We haven't seen it for a long time, and whatever views I could offer. But there's a lot of elements to the operating environment businesses in Australia haven't been used to. So this is historical data. We don't get the latest turnover numbers in that form for another few months, but the quarterly ones give you things like how many people are expecting to leave their current employment in the next 12 months. And here we've got those that are going to retire and those that are expecting to move to another job, and they're surging and they're at record highs and they're picking up. The baby boomers are now really retiring in force. They're a big population bucket. And of course, with the way house prices are gone and superannuation with equities, people are probably financially able to do this. But that number's going up a lot. The Great Resignation, which has been evident in America for 12 months, I believe is starting to happen now quite clearly in Australia. And that has implications for retaining and attracting staff, for wage rates, for working conditions, everything. The numbers are there for all to see. Looking at that as a percentage of employment, you can see on the right there that it's now at the highest level just in 15 years. I just think the trend is quite clear where it's going, and I think this is going to go a lot higher in the next 12 months. Ultimately, though, it does mean wages have to go up. Okay, now so wages have been low, and some people think they should be higher. Businesses, I think, regard labour costs as very high in this country anyway. Whatever the case is, they're going to go higher, and I think it's not just a case of going a little bit higher. The real risk here is that we get a real wage breakout. We've seen it in the United States in the last 12 months. Their labour market is very efficient. Things happen quickly. Ours is not. A lot of the regulations that are put in place in our labour market to protect workers are actually hurting them right now, because it means things like our wage rates are slow to adjust. And of course, inflation and cost of living going up, and wages can't respond quickly. So a lot of these EBAs that are in negotiation now, the industrial action, people having to leave jobs to get pay rises, whatever it is, it's all happening right now. Wage growth will easily get up towards 4 or 5% in my view in the next 12 months. It's a whole new benchmark for what we're used to. Okay, so the inflation story, just quickly. I better get through it quickly. You can see that the original shock it wasn't a supply shock. People talking about it being a supply shock, economists, policymakers. I don't know why they do this. It's almost like they're lying to us. It was a demand shock. When you shut an economy down for health restrictions and you give everyone money to replace the income they're losing through things like JobKeeper, what do people do? They buy stuff. They buy Lego. They buy lawnmowers. They buy fridges and cars. So it's a demand shock. Let me give you a data point. In the United States, 1.7 trillion of durable goods purchases a month prior to the pandemic. Yes, that's a lot of durable goods, more than the Australian economy in total, well more. Okay, 1.7 a month prior to the pandemic. In the last 6 months of 2021, last year, 2.3 trillion a month. From America alone, they wanted an extra 500 billion of stuff that they didn't want before the pandemic. Now, if I was running a manufacturing operation in Germany, let's say I'm BMW, and the pandemic strikes, you're thinking, there could be a slump in demand for my cars because everyone's going to lose their job or whatever. They certainly weren't expecting, let's get ready for a 25% lift. The global manufacturing sector, the global logistics and transport sector could not handle that kind of a sudden shift in the demand for goods. And it's all because of policy stimulus. I'm not arguing that we shouldn't have done it, but it's not a supply shock. It's a demand shock, and it's due to economic policy stimulus. And we need to be clear about that. The economists, the people who told them to do it, the left-wing academics, a lot of people are saying it's a supply problem. Craig Emerson in the AFR saying, it's a supply problem. You can't get the stuff onto the shelves. I don't know where he's getting any of this stuff from. This is a demand shock. You can see what's happening. Producer prices in the world's manufacturing economies are at the highest rate of growth in 40 years. So that's the shock. Now, what I do agree with is the idea that it should be transitory. It should be temporary. This all should settle down. It might take a couple of years, but as long as we don't get this shock to the system into people's inflation expectations, and they start asking for higher wages, and it becomes a sort of inbuilt thing in the system, it should go. So don't jack up rates. Don't sort of react to this temporarily higher inflation. That's fine theoretically. And I wrote a paper about this for the Centre for Independent Studies. It's on their website for free. It's only about a month old, but it's all talks about this stuff. But it's fine theoretically, but in practice, try making that work. Theory, the world's a messy place. And of course, concurrently with this shock, we're getting some of the tightest labour markets in modern history. So it's a brave person to think that we can just ride this out, and the Federal Reserve in the US has obviously had to change their tune. So here in Australia, the shock's about to hit us. In fact, it's hitting us now. This is imported goods prices. So yes, capital goods, i.e. John Deere tractors, consumption goods, the clothes in the shops, the fridges, they've only gone up, and this is 2021. We haven't got the latest figures for this year yet, by sort of 2 to 5%. But imported inputs into production are up by 28%. Yes, oil's playing a big role in that, but it's broader than that. Okay, and that's the biggest annual increase in imported goods prices into this country in 40 years. And that's 45% of all goods that come into Australia go into the production process. So it's just coming through the system now. As I showed you before, this commodity price Australian dollar chart becomes highly relevant here. The Aussie dollar is not buffering us against this global inflation. It's allowing it to be transferred right through. So we're going to see it. We're going to get a quarterly CPI in about 3 weeks for Q1. We already got a high number for Q4 last year, but these next couple are going to be big ones. And this idea that we're going to have 3% inflation is madness. It's going to go up to like 4, 5, maybe even 6. Okay, so we've got overall inflation in the band. The RBA is saying, be patient, let's not worry. Look, normally if interest rates are at a normal level, that'd be fine, but they're at emergency settings. They're at zero. They're running a huge risk by not responding to this. And with the war in Ukraine and various other developments, I just think that risk is way too high, because you do not want to let inflation get away from us with the amount of debt that's sitting in our households. Domestic inflation has been very low. They seem to have been scarred by this, undershooting their target prior to the pandemic. I think it's an absolute irrelevancy now. These academics and, Andrew Lee, the ALP guy, hammering the RBA governor just, a month ago in Senate estimates about why they missed their target on the downside prior to the pandemic. It's like, mate, you got bigger problems to worry about than missing inflation by 50 basis points. Anyway, he's probably going to be an important economic policymaker in Australia in a few months. That's great. Anyway, domestic inflation looks to be contained now, but it's all coming down the pipe, and everyone knows it. Anyone who's in business knows what's going on. Okay, so I've given you a story about the economy, the stresses and strains. What's the budget mean? What have we got to do with the budget? The government's whole strategy with the budget has been to try and grow your way out of problems. So no austerity, no cuts. We're going to try and grow our way through this. So initially that was stimulus in the pandemic, which, was massive, as we know. And it's having its consequences. Look, they didn't know back then that it was going to be as inflationary as it has been, but the reality is that we now have learned just how inflationary that fiscal stimulus is. Anyway, that's passed. At least they've finally recognized it. At least they've recognized that the economy's fully on recovery mode. And the Treasurer said we're going to fiscal consolidation, but it's still about growing the economy, to grow revenues, to reduce expenditures, to fix the budget, not austerity, not cutting back. And there's some merit in it, but typically, historically, you've had to do a bit of both. Anyway, so they're trying to go for gold, you might say. The big question for them now, though, in this economic environment I've just provided for you, is how do you grow an economy operating at capacity? Because any demand you put into the economy is just going to end up as inflation. Okay, we don't have enough workers. You don't have enough trucks, construction capability. The infrastructure plans are great. And that is an attempt to increase the supply side of the economy. But to increase the supply side of the economy, first of all, you got to add to demand by building the thing. And the bottom line is they can't. The most important government announcement last week was the New South Wales government on Monday saying we're actually delaying our infrastructure plans because we can't execute on them. We can't get the job done. So that's the big question. And assessing this budget, how much do they take that into account? Because the reality is, if they want to grow us out of this problem in the next 5 years, if they want to get the debt under control through a stronger economy, they need to get the supply side of the economy moving, because we're operating near that capacity. So that's the strategic issue. You can see here the debt projections. Our debt's not a major issue. I mean, that's why I'm sort of not dying in a ditch about it. But it is rising. And the projections for it to stabilize are exactly that, projections. It ain't stabilizing yet. This is the key way you start with a budget. So let me just explain on the table on the left. The blue bar is what the economy does to the budget. The green bar is what new policy decisions do to the budget. So back in the first pandemic budget, when the thing was, basically the economy was hit by the restrictions and the lockdowns and everything, the economy hurt the budget over the 4-year projection period for 281 billion. Okay, big hit. The government responded with 233 billion of policy measures. JobKeeper, this, that, the other, you've seen it, you've heard it, we've lived it. Utterly appropriate, as we now know, probably a little bit too much, but anyway, that's what they did. Then their budget for 1 year ago, which was 6 months after this, the strategy was working. The economy actually handed the budget back 113 billion in higher revenues, less expenditure requirement. And what did they do? They go, well, look, we've still got this pandemic. We've still got to keep pushing on this. They put 88 billion back into the economy. So what's the difference? 13, 12, 25. They used 25 of the 113 to improve the budget position. My EFO last year, I think it was pretty clear the economy was getting through these things pretty well. They got 47 of new money to the budget. They spent 45. That was the political budget. That was them ensuring that that they did everything to get the economy going when the election was going to be. That's the cynical time. At the time I said, this isn't the right thing to be doing. This is, we now know that the economy is going to go all right as soon as we get past the virus, but no, they put it all back in. This time they got 114 billion from a stronger economy. Commodity prices are a big part of that. Coal, iron ore, but 114 billion. Now, my fear was that they're so far behind in the polls that they're going to chuck 50 or 60 billion of it out the economy. So to their credit, they only spent 30. But the reality is, in a macro perspective, they probably shouldn't have spent a cent. Okay, because most of what they're spending is adding to demand and only making the pressures in the economy worse, making it harder for businesses to get staff, putting more inflation in the system, and stressing and straining the economy. However, what have they done? Let's start with the cost of living. So cutting the fuel excise, economists don't like it. There's lots of good reasons for that. The reason they did it is because they can do it quickly, straight away. It's already in. It's having an effect. It's temporary. They can pull it out. The lower middle income offset, it's a lot of money. The government welfare recipients, totally appropriate in the context of what they're doing. 11 billion to help alleviate cost of living. Now that's going to go straight in the economy. Okay, that's genuine short-term fiscal stimulus. And it's probably inappropriate. It's certainly inappropriate from a macro perspective. However, the government has received a windfall for global energy prices. I think there's a very strong argument to giving that back to those in our community who are most heavily affected. Because despite how strong household savings are and all the other things I've just shown you, the fact is there is a lot of Australians that this has a big impact on. They don't have heaps of savings. They live from paycheck to paycheck. And this is helping those people. And that case can be made very readily. And so I'm completely comfortable with it. This is actually what governments are for in many respects. So I'm not going to get up them about that. The fact that they didn't do other things is what's, I think, really impressive. So the reality is, though, that's going to put more demand in the economy, that's for sure. In terms of businesses, this government's been very good at supporting businesses. They understand how important businesses are to not just our economy, but to our society. Let me just at this point make a very clear point that, there's a mythology in Australia that economic reform, is the be all and end all of productivity. I don't know why this country has absolutely fantasized about this for so long. Economic reform helps. There's no doubt about it. The reality is productivity is about businesses investing in staff, plant and equipment, software. Productivity is about making people, when they turn up to work, produce more for every hour they're on the job. And the leading edge of productivity in every economy is business investment in plant and equipment. Now, this government has been very supportive of that. They've given a few more measures this time around. The apprenticeship subsidy, that's, I suppose it's helpful. I'm not an expert in these things. But if you want to talk about what moves the dial on our economic problems, trying to get the increase in net overseas migration through to the keeper without anyone seeing politically was a very, very good measure. That actually moves the dial on labour supply. That can materially help. Cost of living issues, that probably materially makes our life a bit more difficult, but we know why we did it. It's important that we do it. But all the other stuff in there, the infrastructure, totally support what they're doing with infrastructure. Connecting regional Australia to the capital cities is fantastic. But guess what? They're not going to be able to build anything for years. So it's not going to do anything to solve our problems now. The loss carryback provisions and the instant asset write-off, those two things are very, very good measures they've employed. They're not extending them, but they do finish in over a year's time. So definitely want to be aware of making sure you make the most of those. So I just think it's very important to understand in this context that the government has done, it's been very responsible with what they're doing, in my view. So what's the budget done? There's the history. We now know for sure, no more arguing, the pandemic budget, $134 billion deficit, 6.5% of GDP. That's now behind us. It's done and dusted. Biggest in our history, or at least in our modern history. Current deficit now is 78, down from 98. So they knocked 20 off this year's, despite all that spending, 3.4% of GDP. So let's just be very clear about this. That level of a deficit is basically what we do in a recession. Okay. So we've got an economy that's booming, really. It's booming. It's operating at its capacity. It's got inflation pressures coming through. We're running out of workers, and the budget deficit is still as big as what they normally do in a recession. So that is a failure of policy, and it will have consequences in the economy. And the ones that I'm discussing now are basically those consequences. I think people are aware of that. So anyway, as I said, 114 billion of extra money, 84 went to lower deficits, 30 went to spending, new spending, and 25 of that 30 is this year and next. So they front loaded it. So we do get an improvement in the deficit, but this actually is the really interesting and important question that we shouldn't lose sight of. And that is, our government is no longer planning to get our budget back into balance at any stage in the future. Okay, you can see there that we're going to have a budget deficit of somewhere between 1.5% and 2.5% of GDP for as far as the eye can see. And that's a conversation that has to be had, but we don't have to rush. I'll come back to the economic forecast because I just want to talk about the fiscal position, and I'm going to start here. Our government doesn't have to rush on its long-term sustainability because basically we're better than others. We're more well-behaved. So whether you look at our budget deficits, which last year's at around 4%, you know, United States, UK, Canada, 15%. I mean, no wonder they got an inflation problem. Bloody hell. They are big numbers. You know, Trump and Biden together, I mean, they should start putting those two on US currency. I mean, they've just stimulated the thing beyond all unbelievable. I mean, the pandemic really created some amazing responses. But you look at to the right, we've got government debt, which in Australia is 35% of GDP. Versus other countries. Japan's obviously the world leader. I'm not sure exactly how they're going to pay that off or in what century. Well, they don't have to pay it off, but you know how sustainable it is. But I'll put this up against household debt because it's essentially been the way we have gone about it for generations in terms of getting government finances in order, not running these structural deficits like other countries. We have the highest household debt in the world. Okay, so it's fine for us to say, actually, let's just bail out on this fiscal responsibility stuff. It doesn't work. Let's just have a structural deficit. The government will get out there and do a lot of stuff, and we'll rack up heaps of debt. You know, fine, let's do that. But just remember, when you make that commitment to do that, there's going to be some consequences. And I imagine some of those consequences will mean the system will adjust in a way that will reduce our household debt, and it probably won't be pretty. So that's just an important thing to bear in mind, that you can't just say, oh, we have lower debt than other countries, so why don't we just run up heaps of debt? Well, all our economic structures are based on what we've been doing. You can change it. We're a democracy. We can have that conversation. But just remember, when you change it, it's going to have implications for other parts of the economy. Okay, before I get to the big issue on that structural side, I just want to go through their forecasts. They're very credible. Treasury does a great job. You know, they're conservative. They're not out of this world. There's definitely nothing in those forecasts that are pandering to the government. The economy is expected to continue to expand. As you can imagine, you can only get so much real economic growth when you're at capacity. Unless your supply side's growing, you know, you can only grow so much. So they got 2.5 as the settle point. I think it's going to be lower than that unless we can work out how to suddenly increase our labor supply by a lot more. But anyway, the point is that in the year ahead, we've got a strong consumer, businesses investing. In fact, their assumptions on business investment are very strong, both this year and next. You're seeing that in the credit numbers. Businesses are borrowing. I'm not just saying that because I'm a judo. The data's there. The one thing of contention is inflation. So they've got inflation going to 4.25% this year. At least they recognize that. Governments and RBAs, they were only talking about very low inflation 6 weeks ago. You can just see they're going to blame the Ukraine on everything when this has actually all been happening for a lot longer than that. But anyway, inflation at 4, then settling back to 3. That's the point. I hope that happens. They're assuming the RBA, and they've got something in there that says the RBA will start raising rates in mid-2022. So that pretty much seals it for a rate hike in the next month or two. But the key issue is it going to settle back? And how much work does the RBA have to do? And I'll finish up on that point. So that's a very courageous forecast. All the risks are higher there. Wages getting to 3.25%. They're getting politically absolutely beaten up by the fact that they haven't hit their wage forecast. It's been too low. That's fine. I don't think it's anything they could have done about it. You know, they don't control global labor supply and various other things. The reality is, if this wage forecast is going to be wrong, it's going to be wrong by a percentage point too low. Wages growth's coming through, that's for sure. And then, of course, unemployment. The holy grail of this whole thing is getting that down as low as they possibly can. You can see the chart there. We had a structural shift up in just about every Western country in the early 1970s. That was obviously the initiation of the welfare state, Lyndon Johnson's Great Society, all that sort of stuff. I won't go into that in any detail because I'm sure I'll get beaten up by a bunch of people about it. But anyway, the point is, we haven't seen this for 50 years. They're forecasting 3.75%. It's good to see they're so ambitious. It was 4% in February. I mean, they're looking for 25 basis points of declines in the unemployment rate. That's my forecast. I reckon it's going to 2.8%. The reality is it's about what's sustainable. So I think we're actually at our full employment level. And that forecast there is the absolute dream, that we get unemployment going down to sort of 3. It might have to come up a little bit, that it stabilizes at 3.5. That would be wonderful. We'd all love to see that. But you know what? The further down you go, the more chance it's going to end up overheating the economy. They're going to have to jack up rates. You're going to end up causing a recession and unemployment going up quite a bit. So it's all about doing it on a sustainable basis. How low can you go? It's not about how far you can go down. It's about how long you can stay down. There must be a diving analogy. I'll have to speak to someone who's an expert in these things about how to get that analogy. Anyway, the forecasts are fine. The iron ore projections, the coal projections, as usual, they're not baking in these high prices, which is a critical part of modern fiscal management for 20 years now. They don't bake it in, which is really important. So if these prices stay where they are, that's an extra 30 billion a year or something like that in revenues for the government, and obviously massive amounts of income for the Australian economy. But they're being conservative, as they always are, which is important. Okay, back to this. This really is the most important chart when you're looking at Australia's fiscal policy, budget, government's finances, and that is this government, despite trying to paint its picture as being a Liberal National right-wing coalition, has actually made Gough Whitlam look like, a headmaster. We have got baked in the highest rate of government spending in this country for the next 10 years that we've ever seen. Okay, and this budget, they've done absolutely nothing about it. Okay, all of the increase in all the improvement in the budget position in the last year, that 114 billion, just about all of it was on the revenue side. And this is the question we have to ask. One, do we ever want to have a budget that's back into balance again? Okay, that's the first question. I explained before why you might want to have that discussion, because if you don't, you might have some implications for household debt. And then two, if we say we do want to have a balanced budget again, how are we going to do it? We're going to cut spending, or we're going to raise taxes? What's going to happen? We don't need to, the government didn't need to do that this time around. It's a pre-election budget. Come on, let's be realistic. However, this question should be, we've got to have this conversation as a nation in the next term of government. And that's why this election is quite important in that respect, because I'm sure the two different parties will have two different views on this. We've got some significant new long-term spending commitments related to the NDIS. That thing is costing us an absolute fortune. I'm not saying it's wrong, but it's expensive. Everyone needs to know what it costs and where our taxes are going. They put another 40 billion into that. I mean, it's just absolutely exploded. The aging population will only do one thing to long-term spending requirements and push it up. And of course, defense, they put more money into defense. The way the world's going, God only knows where that's going. But back in the 1950s and 60s, regularly spent 5% of GDP on defense. We're maybe going for 2.5. So if the world continues to deteriorate, that's only going one way. Anyway, you get the idea. We've got to have this conversation. We've got time. We could probably get away with it for a few more years. I mean, we do have low government debt, but I think I've got this feeling that it's going to start to impact the economy. And you can see it. Government bond yields are going up, and it's really important. And this is the issue about costs, okay? Just to be clear, I'm not going to dwell on it. These are the interest costs, okay? And they've tried to sort of sell us that, it's fine to have this debt because the interest rates are low. So the interest costs are going up, but they're not going up all that much. And as a share of GDP, they're pretty stable. I've been involved in fixed income for a long time. I know about government debt portfolios, and I looked in the fine print. Their assumption for the cost of government money for the next however long, 20 years, is 2.2%, up from 1.7 6 months ago. I haven't checked the market today, but the 10-year bond yield is 2.9% and 3-year bond yield is 2.4%. Okay, the numbers are already wrong. If that 2.2 goes to 5 because we can't control inflation and we have to put interest rates up, or for some other reason, the cost of this debt is going to become a massive part of our government's budget. Okay, now that's the other reason we have to have the national conversation. One of the great benefits of low debt in the last 20 years has been that we haven't had to dedicate recurrent spending to paying the interest cost. That's fine, we can do it, but everyone's got to understand what we're sacrificing. What are the twos and the fros? I just love it how they just sneak that in the absolute fine print. 2.2, yeah, right. There's no way it's going to be 2.2. That is probably the most cynical part of the budget, but anyway, we won't go to media. Treasury's factoring in the RBA raising rates from mid-year. Okay, I'll wrap it up quickly. I'll leave this one. It just shows that our government's getting less functional. More and more votes are going to minor parties. It's been a trend in place now for a long time. We're going to see a record number of minor parties. The reason I raise it is that our government's getting less and less able to work, basically. Back when two parties ruled, we could get stuff done. It's getting harder. Interest rates. There's my outlook for the next 10 years for the cash rate, and that'll be a great outcome. Slow grind higher, higher inflation, solid economy, few wobbles here and there, but we get there. What we do not want to see, whether it's because of that government debt or because of all those households out there who have massive mortgages, is the RBA to get behind the game and have to jack up rates a lot more. We've got a mortgage rate, let's call it 2, which is a cash rate of basically 0. I think the RBA can take the interest rate to 2 or 3% over the next 5 years, the mortgage rate to around 4 or 5%, and we'll adjust to that. What we can't do is have the mortgage rate go to 7 or 8%. That will create a very profound problem within our household balance sheets. So that's the main game here. This is the main threat, is making sure that we keep inflation under control. And I think that's why the risks the RBA are running are unacceptable, to be honest. And they're stuck in the past. They're worried about too low inflation of the last decade, when the problem now is too higher inflation, and they've got to be more agile. The deputy governor just quit. I've never seen anything like it. Obviously, it's not because he thinks that they're doing the wrong thing. Well, I don't know. I don't know him personally, so it's all very suspicious. They've got to start raising rates. They've got to take that risk out of the economy. And yes, people are going to hate it, but that's why they're paid to do that role, and that's why they're doing that role, to make important decisions in the best interest of the whole community over the long term. Right now, I don't believe they're doing that. Okay, I'll have to cut here so we can get some questions in. I want to finish off. The last 10 years, the reason we've had very little productivity growth is because investment in plant and equipment in this economy has been going sideways. Okay, I don't want to go into the reasons why that is. We want to re-find the 90s and the noughties of rising business spending on stuff that makes people more productive, on software, on plant and equipment, on people training skills. We've got an opportunity here to refit this whole economy for new technologies. I'm very bullish on the role of the business community and businesses in investing and making this a better place to work, a more productive economy over the next 10 years. That's my bottom line. This is what's going to drive a better economy, a better community, not big government spending. Government has to regulate. I'm not a small government guy. I'm just saying that the business sector is the place to focus on. And I think that, and then before this budget, before this war, through this last couple of years, my thinking on the medium term has been very much about a business-led economic expansion. The two things we have to watch out for, that I have no idea ultimately what's going to happen, but I think they're our greatest threat, is, as I said, rising interest rates that are going up a lot more than what we need them to be. It's fine to go up 2%, probably fine to go up 3%. No good, can't have them going up 5 or 6%. That will ruin the economy. And then the other one is obviously geopolitical, which we could spend an hour on by itself. But obviously, if the whole China-Russia thing persists and gets worse, then that's a major problem. I'll leave it there. Thank you for listening.
Yeah, thanks very much, Warren. So I think we'll take questions now. So there's the Q&A chat function there. Post them up, and there's a question to start with, Warren. Any ideas why the Aussie dollar is not following the typical historical trend with commodity prices?
Yeah, no, it's a really critical question. I can't say I'm confident in my answer, but what I've been thinking about for quite some time now, a year or so, is why. So in terms of that relationship directly, normally when commodity prices are very high, the global mining companies are investing in new capacity, and they're bringing that money in from overseas, and then they're actually building things and bringing in equipment and even people and stuff. So I think what we're missing on this cycle is a big increase in capacity, another mining boom, basically. And that, of course, would have normally represented a big demand for Aussie dollars, a lot of capital coming into our country, and that's not happening. Now, I think that could start to happen over the course of the next few years. Mining investment's very, very low right now. I don't think we want to build a whole bunch more capacity in iron ore and coal necessarily. We don't want to get more exposed to China necessarily, although there's an India story there. But I just sense that there's going to be some new stuff happening, whether it's around the energy transition, whether it's new industrial materials. So I think that'll start to happen, but it won't save our bacon in the next 12 months. The other one is QE. The government bought all the government bonds. I spent my career traveling the world trying to get investors to buy Australian government bonds, federal, state, and then the RBA just went and bought them all. So the foreign ownership of Australian government bond markets is very low, and that's of course an important capital inflow, which represents the purchase of Australian dollars. So I'd have to do a lot of work on that. I haven't, but I suspect that's playing a role. It might only be at the margin. Beyond that, I'm not sure. But the reality is that the fact that the Aussie dollar is where it is now, when all these prices around the world are so high, is going to be inflationary.
It's an interesting one. That in terms of, is your prediction the Aussie dollar might actually go up a bit higher?
Yeah. I mean, I've been saying this the whole time. I just can't, how can it go down? It's sort of, it should be at like 90 cents. It should be a parity. So I think it'll go up to 80. It'll be a bit of a grind. The big one from the mining point of view is if Russia and China sort of dislodge and get together and stuff, is what does that mean? And I think it actually means a lot more mining investment here, from European and American money, and our own. We've got a fair bit these days, as my data showed. Just remember, you don't fear that we sell iron ore to China. What we do and have been doing for generations is we sell iron ore to who makes steel. Before China, it was Taiwan, Korea, and Japan. China muscled in on the action, so we sold it to them. If they cut themselves off from the world, someone else is going to have to make steel, whether it's America, India, us, and we'll sell it to them. We don't sell iron ore to China. We sell iron ore to who makes steel. So we don't need to worry about China as such. We need to worry about the global demand for steel.
So there's a question from Kayleen following on from that, which let's pull it up. Sorry, Kayleen, did you say that, Chris? Can you say that question?
I can. The question is from Kayleen: why doesn't anyone talk about the impact of China, especially as it has raised export duty significantly, and it's also one of the biggest global markets?
The impact of China on our economy, sorry?
Yes, I think that's what Kayleen is asking.
Yeah. Well, the reality is that our exports to China are sort of at record highs. Admittedly, it's not in wine, it's in iron ore. So we're still trading with them heavily. We're trying to manage an extraordinarily difficult geopolitical situation. I mean, you probably saw what's going on in the Solomon Islands. That's beyond belief, what they're doing there. And of course, 4 weeks after Russia invades Ukraine, it's extraordinarily scary. So we're trading with them. And yes, if that trade all just shut off, that would be massively disruptive, to parts of our economy and eventually hurt our economy. But at the moment, we're still trading with them. And the good thing about being a primary commodity producer, and it really is the foundation of our prosperity in this country, the fact that we have energy of all types. We have minerals, we have agriculture. From day one of modern Australia, that's been the foundation of our prosperity. And we'll find somewhere to sell there's going to be people who need this stuff, even if we sell it cheaper than others, whatever. Yes, China could be disruptive in the short term. China's got its own problems, big time, both economically unsustainable and now geopolitically. And that's what worries me, actually, that the whole thing in China is really going to come to a crescendo, and maybe in a very unpleasant way. Our opportunities lie elsewhere now, in places like India and Southeast Asia, Africa, and hopefully the world remains stable and peaceful enough for us to realise those over the decades ahead.
Carmen says it's more about talking about costs of goods coming into Australia and so much more of what we use come from.
Oh, yeah, no, yeah, well, of course. And look, the cost of goods from anywhere in the world is going up because the Aussie dollar is low. So it's making it hard. A lot of that business investment is actually with equipment that's from overseas. So that's a problem. In terms of China, look, we're already onshoring. Supply chain resilience has been an issue now for a while. To be fair, China's industrial structure has been shifting. Look, I don't have any profound insight. And of course, if we just said we're not buying anything from China, if the world put sanctions on China in a similar way to Russia, it would be very disruptive. It would force a lot of onshoring. So I think, in the budget, again, there was a lot of stuff in there related to rebuilding Australian manufacturing. And I think that's a very real thing. I think it's already happening. We're not going to rebuild. We're not going to build everything. We're not going to build cars or not mass cars. But globally, between Europe and Australia and various other America, we may have to consider what we need to produce onshore versus what we're reliant on China for. But at the moment, China needs the money, right? So they're going to want to sell this stuff.
Big question, and I'll be interested in this one. House prices, where are they going to
go? Look, I've been sort of positive on housing, on house prices this year, despite sort of this sense that it's time for them to come down, particularly if rates are going up. I mean, I've been calling higher rates longer than anyone, but the reason I'm positive on housing is all that saving. I think that saving sits with high and high middle income earners, and I think a lot of that money will find its way into property in some way, shape, or form. So I think it's going to be very much an investor-led market. And I don't necessarily agree with that. I don't think that's good for our country. I think the environment now is going to really highlight some of the fundamental structural problems in our housing market, particularly in relation to affordable housing. The concept of affordable housing goes beyond just the most vulnerable in our community, it's broader than that now. But I don't think house prices are about to collapse. I think if interest rates go up by 2 or 3 percentage points over the next 5 years, house prices in 5 years' time will still be about 10% higher. Are we going to see another 10, 20, 30% rise in house prices anytime soon? No. Interest rates are now basically gone to zero. It's those movements in interest rates which cause the repricing of the whole housing stock. Housing, we're going to do well with interest rates going back up again to keep house prices steady. And as we saw historically, house prices will be as much about income growth as they will about interest rates going forward. So I'm not looking for a major collapse. The risk, of course, is that the RBA has really got this wrong. Interest rates have to get jacked up, put the economy into recession. And of course, the transmission mechanism for that will be the housing market. And we want to avoid that outcome at all costs. I think we're going to get a bit more insight into that over the next 6 months. At the moment, I see that as still a 1 in 5, 1 in 4 type probability.
Interesting. Well, I think we're probably right on time. So Warren, thank you very much for a very punchy, insightful presentation. It's been excellent, actually. Thank you very much for that, Con. I want to thank you for organising all this, and Judo Bank for attending today. Thanks everybody for spending the time over your lunchtime with us, and we look forward to the next Red into Black seminar. So thanks again. We'll call it a day.
Thank you very much.
Thanks, Stephen.
Thanks,
John.
Thank you. See everyone.